Mortgage rates have just surged to their highest level in over 20 years, and that could drastically change your home buying plans. In fact, the average rate has jumped by over 3% in the past year alone, making loans more expensive than ever before. If you're thinking about buying a home or refinancing, this news might feel overwhelming. But don't worry, this video will help you understand what these changes mean for you and how to navigate this new landscape. Whether you're a first-time buyer or a seasoned investor, knowing how to adapt now could save you thousands. So, if you want to stay ahead of the market and make smart financial decisions, make sure to like, subscribe, and stay tuned. Now, let me show you why this is so urgent and what you need to know before getting started. Mortgage rates have just hit a 20-year high, marking a significant shift in the U.S. housing market. This surge means that borrowing costs for home buyers and investors are now higher than they've been in 2 decades. If you're considering buying a home, refinancing, or investing in real estate, this update is crucial because it directly impacts your finances and your future plans. Right now, in the context of the U.S. economy, rising mortgage rates are a response to inflation concerns and efforts by the Federal Reserve to cool down economic growth. These changes affect not only individual buyers, but also the broader housing market, potentially slowing down home sales and impacting property values. Whether you're a first-time buyer, a homeowner looking to refinance, or an investor, understanding these dynamics is essential. You'll learn how these rising rates influence mortgage affordability and what strategies you can adopt to protect your financial interests. By the end of this, you will have a clearer picture of what this historic increase means for your plans and how to navigate the current landscape effectively. You'll be better equipped to make informed decisions in this challenging environment. But to make smart decisions, you first need to understand the economic landscape we're dealing with. Mortgage rates have recently surged to their highest levels in over 20 years, impacting millions of home buyers and investors across the United States. According to the Federal Reserve and data from Fred, the average 30-year fixed mortgage rate has climbed above 7%, a significant increase from just a year ago when rates hovered around 4.5%. This sharp rise is largely driven by ongoing inflation concerns and the Federal Reserve's aggressive interest rate hikes aimed at cooling the economy. Inflation, currently running over 3% annually per the Bureau of Labor Statistics, exerts upward pressure on interest rates because lenders demand higher returns to offset decreasing purchasing power. As the Fed raises rates to control inflation, borrowing costs for mortgages also increase, making home loans more expensive. This creates a ripple effect. Higher mortgage rates can lead to decreased housing affordability, slowing down sales, and potentially putting downward pressure on property values. Additionally, tax policies and housing market cycles influence this environment. Elevated mortgage rates can discourage new home purchases, especially among first-time buyers, while investors may reassess their strategies amid changing market conditions. The combination of rising interest rates and inflation signals a period of adjustment, where the housing market may experience slower growth or even a temporary slowdown. Understanding this macroeconomic backdrop is crucial for navigating current real estate decisions. With that context in mind, let's break down a strategy you can actually apply. Mortgage rates have recently reached their highest level in over 20 years, which can feel overwhelming for many potential homebuyers and investors. When mortgage rates go up, borrowing money to buy a home becomes more expensive. This means your monthly payments increase, making it harder to afford the home you want. But understanding what to do next can help you navigate this change more confidently. The main strategy involves carefully planning your financial actions around these higher rates. One key concept is locking in a mortgage rate early, so you avoid future increases. Another important idea is pre-approval, which means getting approved for a loan before you start shopping, giving you a clearer picture of what you can afford, even if rates rise further. It's also crucial to understand fixed-rate versus variable-rate mortgages. Fixed-rate loans keep the same interest rate throughout the loan, providing predictability. Variable-rate loans might start lower, but can increase over time, especially if rates are rising overall. Choosing the right type depends on your financial situation and how long you plan to stay in the home. Additionally, some buyers consider buying down the rate by paying points up front to lower their interest rate. This can be a smart move if you plan to stay in a home for a long time and want to reduce your monthly payments. By understanding these basic terms and strategies, you can make smarter decisions in a rising rate environment. Now let's look at a real-world example to see exactly how this plays out in practice. Mortgage rates have just hit a 20-year high, now exceeding 7%, and it's changing the game for homebuyers. Let's walk through a realistic example of how this impacts your finances. Imagine you're looking at a $300,000 home in the U.S. and planning to make a 20% down payment of $60,000. That leaves a loan amount of $240,000. Using a mortgage calculator at a 7.2% interest rate for a 30-year fixed loan, your monthly principal and interest payment would be roughly $1,560. Add estimated property taxes and insurance, say $400 monthly, and your total monthly payment climbs to around $1,960. Compare this to just a year ago, when rates were around 4%. And the same loan would have meant a monthly payment closer to $1,150, saving you nearly $800 each month. This increase significantly impacts affordability, especially for first-time buyers. It also affects the potential return if you're an investor. Higher monthly costs mean lower cash flow and possibly diminished profit margins. If property values don't rise as quickly or even decline, your return on investment could suffer. To put this into perspective, consider how a small change in interest rates can alter your total paid over the life of the loan. At 7.2%, over 30 years, you'd pay roughly $122,400 in interest alone, more than double what you'd pay at 4%. This looks great, but only if you avoid the common traps that ruin deals like this. Stay tuned to learn the key strategies to protect your investment in this rising rate environment. Mortgage rates have just hit a 20-year high, and many homebuyers are feeling the pressure. While rising rates can seem daunting, it's essential to focus on strategies that protect your investment and set you on the right path. However, there are common pitfalls that can derail your success if you're not careful. First, one of the biggest mistakes is neglecting your credit health. Poor credit management can lead to higher interest rates or even disqualification. Always check your credit report ahead of time, correct errors, and pay down debts to improve your score. Second, rushing into a loan without doing thorough research can be costly. Some buyers overpay by not shopping around for the best mortgage terms or failing to compare fixed versus variable rates. Take the time to explore your options. Small differences in rates can save you thousands over the life of the loan. Third, skipping due diligence on property costs and future expenses can catch you off guard. Hidden issues or underestimated maintenance costs might strain your budget later. Conduct inspections and get clear estimates to avoid surprises. Lastly, many overlook the importance of locking in a rate early. With rates still fluctuating, waiting too long or delaying your decision can result in higher costs. Secure your rate when you're ready to move forward. To avoid those mistakes, here are the best tools and resources available right now. Mortgage rates have just soared to a 20-year high, making home buying and refinancing more challenging than ever. But don't worry, there are practical steps and tools you can use right now to navigate this changing landscape. First, check your credit score and report, because a healthy credit profile can help you secure better loan terms. Platforms like Credit Karma, creditkarma.com, and Annual Credit Report, annualcreditreport.com, offer free, easy access to your credit information and tips on improving it. Next, explore mortgage rate comparison sites such as Bankrate, bankrate.com, and NerdWallet, nerdwallet.com. These platforms allow you to compare fixed and variable rate offers from various lenders, helping you find the best possible deal in this high-rate environment. Additionally, use real estate platforms like Redfin, redfin.com, and Zillow, zillow.com, to monitor local market trends, property values, and mortgage options, so you're prepared when you decide to buy or refinance. Lastly, consider financial planning apps like Mint, mint.com, or Personal Capital, personalcapital.com, to help you create a budget that accounts for higher mortgage payments, ensuring your financial stability. Now that you've got the tools, let's talk about the first thing you can do today to get started. Begin by checking your credit score and report. Understanding where you stand will help you identify opportunities to improve your credit, potentially lowering your interest rates and saving you thousands over the life of your loan. Taking this initial step positions you to make more informed decisions in a market that's constantly changing. Mortgage rates have just hit a 20-year high, making homeownership and refinancing more challenging than ever. But instead of feeling overwhelmed, take one small, realistic step today that can set you on the path to financial confidence. Start by checking your credit score. Download a free app like Credit Karma or visit annualcreditreport.com to see where you stand. Knowing your credit health unlocks important opportunities, lower interest rates, better loan options, and a clearer picture of what you can afford. This simple action helps you identify areas for improvement and gives you control over your financial future. Taking this first step creates momentum. It's easy to feel stuck when the market shifts, but small, consistent efforts build confidence and clarity. Once you know your credit status, you can explore tailored loan options, compare rates, or even plan your next move more strategically. Remember, every long-term success story begins with a single, doable action. Today's step, checking your credit, lays the foundation for smarter decisions tomorrow. As you stay consistent in managing your finances, you'll find yourself better prepared to navigate high rates, secure favorable terms, and work toward your homeownership goals. Taking that first step is how every long-term success story begins. Let's look at what happens when you stay consistent. In 5 years, imagine having built a solid portfolio of 3 rental properties that generate steady cash flow, helping you cover your living expenses and secure your financial future. Fast forward 10 years, and those properties could have appreciated significantly, increasing your net worth and providing you with options you never thought possible. Even with current high mortgage rates, consistent effort and strategic planning can turn today's challenges into tomorrow's opportunities. Think about it. By 2035, with disciplined saving, smart property management, and patience, you might own 5 cash-flowing properties, each one steadily growing in value, providing passive income, and building wealth that compounds over time. It's not about quick wins. It's about the power of persistence and long-term vision. Remember, real estate is a marathon, not a sprint. The decisions you make today, whether to lock in a fixed rate, improve your credit, or start saving, set the foundation for future growth. The market may shift, but your commitment to steady progress can help you ride out the waves and come out stronger. And now that you see what's possible, here's how we wrap this up and take action. Start by evaluating your credit, exploring your options, and creating a plan. Consistency over time is the key. Small steps today can lead to a future where property ownership is within your reach and your wealth continues to grow. The journey begins now. Are you ready to take the first step? Breaking news. Mortgage rates have just hit a 20-year high, and I know that can feel overwhelming. But don't worry, this is a moment to stay calm, stay strategic, and look at the bigger picture. Higher rates mean borrowing costs are up, which can slow down the housing market and impact your plans if you're thinking of buying or refinancing. However, it's also an opportunity to reassess your financial goals, explore different mortgage options, and strengthen your credit profile to get the best possible terms when the market shifts again. Remember, understanding these changes helps you make smarter decisions. Whether you're a potential homebuyer, investor, or just planning your financial future, staying informed and adaptable is key. The market will fluctuate, but your long-term vision and disciplined approach will keep you ahead. Thanks so much for watching and for being part of this journey. Every challenge is a chance to learn and grow, so keep pushing forward. If you found this helpful, make sure to hit that like button, subscribe for more updates, and comment below. What's your top financial goal for this year? And don't forget to check out a related video on how to lock in the best mortgage rates to keep building your knowledge. Stay confident, stay focused, and remember, your financial future is worth it. See you in the next one.